So, good morning, afternoon, and evening, everyone. Welcome to December's edition of the Esgian Rig webinar series. In today's presentation, we will be reviewing 2022 rig activity along with Esgian's 2023 forecast. Today's presenters are Cinnamon Edrelin, head of our Esgian Rig market research team, and Matthew Donovan, our senior rig analyst. Before we start the presentation, just a couple of housekeeping notes. The presentation will last approximately 30 minutes and we will include some time for Q&A at the end. To ask a question, please use the Q&A box on the right side panel of today's event window. Today's presentation is also being recorded and will be posted on the Esgian website later this week. I would like now to thank Cinnamon and Matthew to start the presentation. Cinnamon.
Okay, thank you, Paul, and thank you everyone for joining us today for our webinar 2022 Finishes Strong, but 2023 will be stronger. Here's the disclaimer we've all come to know and love. We're going to start with a short introduction of Esgian, and then Matthew will go over some 2022 highlights and trends, and I'll come back on to go over our 2023 outlook and themes before wrapping up and turning it back to Paul for the Q&A section. So beginning with a little refresher for some of you or an introduction for others of who Esgian is. Esgian is a relatively new company on the market, but we are built on a foundation of over 4 decades of history. A few names you might recognize are on the screen in front of you as part of our history: Basso Offshore and ODS Petrodata. In addition to offshore rigs, Esgian also tracks offshore wind market and the shipping market. One thing that makes Esgian unique in the market, though, is all 3 of these segments have a green twist. Esgian, as it stands today, was founded in 2019. We have over 40 employees globally. Most of us are located in either Norway, the UK, or the US, but we do have colleagues in a few other locations as well. As I mentioned earlier, we have the 3 components that make up our company: shipping, rigs, and wind. Today, we'll be drawing from the rigs offerings. Our rig services package includes rig analytics, which contains the commercial market information. Rig values is our valuations and sales information, and green packed rigs is where you'll find our emissions information. On the right side of the screen, it gives you an idea of how we do what we do. On the left are some of the data inputs that we use, and things vary from direct sourcing to public domain. And then when you're talking about emissions, for instance, we'll use weather data. And in some cases, we have sensor data that we use in partnership with a couple of rig contractors where we're gathering that information to help inform our products. All this various information from these sources then gets fed into our models and analytics. And from that comes our output, whether that's our databases, our various reports, or even the presentations such as today's. And now I'll turn it over to Matthew to go over the highlights from 2022.
Thank you very much, Cinnamon. So, offshore rig activity has risen over 2022. This has been a year of recovery for the offshore rig market, spurred by high commodity prices and the geopolitical instability that has pushed those prices higher. What we've seen over this year is drillship utilization rose significantly. Competitive utilization for drillships went from 74% at the beginning of the year to around 85% as of late November. And that has been supported by work for 6th and 7th generation drillships in the Golden Triangle area, including the US Gulf of Mexico, Brazil, and West Africa, as operators in those regions have picked up these high-spec rigs. The working jackup count globally has also remained high, and that's primarily been due to demand in the Middle East. What we've seen over 2022 is that many new and high-spec jackup units have been contracted for multi-year terms, beginning in late 2022 into 2023. And what that's been doing globally is soaking up some of the excess capacity from other jackup markets as rigs have moved from areas like Mexico, Southeast Asia, and even Northwest Europe to the Middle East to meet the rising demand there. Semi-submersible utilization, that has lagged behind drill ships but has trended upwards over the years, and activity for drill ships has remained stable in recent months. And what we've been seeing is that as the drill ship market has tightened, that has also pulled up activity for the top level high spec semis that also compete in the same space. Turning now to day rate fixtures for offshore rigs. We've seen day rate fixtures for offshore rigs rise over the year due to that tightening supply. What you can see on the chart there of offshore rig fixtures is some recent dips, and those indicate exercised options at previously agreed prices. Of course, as these options are exercised, they come in at less than the leading edge day rate. But as we come to the end of the year and move into 2023, the less of those options at previous benchmark prices that will be available. So we're moving into a higher day rate environment as we move into 2023. Looking at rig sales over the year, rig sales this year have been boosted by Middle Eastern drilling contractors expanding their fleet. We've seen 56 total offshore rig sales to date this year, and interestingly, most of those were for continued use as drilling units. This has been a reversal from previous trends, and in recent years, we saw a lot of rigs sold for recycling or for conversion. But this year, what we've mostly seen is units sold to continue working as drilling rigs. The 45 jackups sold to date include 20 bought by ADES, 11 by ADNOC, and 3 by Arabian Drilling, as these Middle Eastern contractors, as I said, expand their fleets and bring in units from other regions. We have seen 2 drill ships sold this year, both very recently. The new build drill ship West Aquila was bought by L'Aquila Ventures for $200 million, and that drill ship will be managed by Transocean, who have a stake in the holding company. And also recently, Saipem exercised an option to purchase the Santorini for $230 million. That's another drill ship, and that was already with Saipem on a bareboat charter. So they'll continue working with that rig going forward, and it shows the increased interest in high-spec drill ships. We have seen 10 semi-submersibles sold this year. Only 4 of those were sold for use as drilling rigs. Most recently, a 10,000-foot rig built in 2012 was sold for $60 million at auction, and that will work in Mexico, presumably. Looking now at offshore drilling contractor fleet size. This is something that has changed over this year and is indeed markedly different from previous years. What we're seeing is drilling contractors once again interested in acquiring units after several years of downsizing many fleets. As I mentioned previously, the Middle Eastern-focused contractors, including ADES, Arabian Drilling, and ADNOC Drilling, have significantly increased their fleets this year to meet rising jackup demand in the region. Another major change in 2022 is Noble, which had previously grown through its 2021 acquisition of Pacific Drilling, and now has completed its 2022 merger with Maersk Drilling, adding to both its floating rig and jackup fleets. Interestingly, Coastal remains the largest overall fleet in terms of rigs managed. While most of its fleet is focused on the Chinese markets, these units also work in the Middle East, North Sea, and Mexico. And in terms of managed fleet, Transocean is the largest floating rig contractor with 39 units, followed by Noble with 19 and Valaris with 18. And all 3 of those have completed major acquisitions of floating rigs over the past several years. Looking at our emissions space, 2022 has seen increased activity and a raised focus on emissions for offshore rigs, and that's something we expect to see continuing into 2023. 2022 started with a careful approach to implementing emissions reduction technology, but as we had the energy conflict, which resulted in increased energy demand that could not be answered with renewable energy on its own, we saw a situation where companies need to both increase production and continue to reduce their emissions. So we have seen an uptick in the emissions reductions activity being installed on rigs. This increased in the latter half of 2022, and we anticipate the installation of these systems will increase in 2023 and beyond. Looking at the chart there, you can see that 2022 saw the installation of emissions reduction systems that target both CO2 and NOx. Looking at a fleet in terms of rig emissions and emission reduction systems and their implementers, what we've seen is the industry realize the potential in a great variety of emission reduction systems. What we've got is also software and digitalization to improve emissions and time spent on the well as hardware, from a hardware perspective, SCR systems and closed bus systems. In addition to that, you also have alternative fuels and additives being tested. So there's a wide variety of solutions for emission reductions. In terms of the operators who have these rigs, of the 43 offshore rigs that have emissions reduction systems installed, you can see on the left-hand chart the focus of North Sea focused contractors on those. So with Odefjell Drilling, Transocean, and Noble, with the absorption of the Maersk drilling fleet, lead the way in units with emissions reduction technology installed. And in terms of the technology solutions, you see a high percentage are using the hardware solutions of SCR scrubbers and closed bus systems.
Thanks, Matthew. And now we'll switch over to our outlook for 2023. 2022 has been a year of growth. Over the course of this year so far, we've seen demand growth of about 6% globally. But as mentioned in the title screen, we are expecting 2023 will be an even stronger year and are currently expecting demand growth of about 13% globally. One of the drivers of demand is the price of oil. On the right, you'll see the average Brent price for last year was about $71. This year it's been about $101. And the EIA is forecasting about 92 for next year. While the 92 is a bit of a drop from this year's price, it is very comfortably high for operators to still be profitable and is not expected to have any kind of a negative impact on demand. And so while we are talking about demand going up and day rates going up, we want to take a moment to make sure we're practical on some aspects and acknowledge some of the challenges that are within the market. For instance, personnel. We're talking about not just offshore crew on the rigs itself, but also onshore crew, staffing, project-related staff. In some cases, we're hearing about operators that have multiple projects that they're ready to move forward with, but they don't have enough personnel to staff all of them. So they're having to pick and choose which ones they want to move forward with. Also, reactivation staff. We lost a lot of people during the previous downturn. Many of them retired and some went to other industries. So we have a gap in knowledge. And so what we've heard from some operators is a way to work around this is they've started some sort of mentoring groups with retired personnel who have the experience from previous reactivations to work with and share their knowledge, people who are newer to the industry, and this may be one of a few times they've worked on a reactivation. Now, COVID-19 is still contributing to supply chain challenges globally. Lead times continue to grow for orders. While fuel costs have dropped from where they were a few months ago, they are still rather high. And in some cases, it's led to operators going a bit more in depth on their decisions about whether they want to use a single rig and mobilize it to multiple locations, multiple countries or regions in some cases, or whether it might be better to pick up a different rig that's locally for that short program. And then we also have inflation. Inflation is being felt across the board and globally. So we're seeing increasing labor costs, parts, and also services. And all this is also putting pressure on reactivations. At the beginning of this year, you could reactivate a seventh generation drill ship in about 6 to 9 months at a cost of about maybe 40 to 60 million. If you were to try to replicate that same exercise now, you're looking at a time period of about 12 to 18 months and a cost of more like 75 to 100 million. And so what this means for operators who haven't yet secured a rig for 2023 is if they are eyeing a rig that's currently stacked and may be in need of reactivation, if they haven't already put something in motion and got that going, it's unlikely that they'll be able to get something reactivated on short-term notice for next year. So rig supply took a major hit during our prolonged downturn. On the right, you have two charts. The jackups are on the top and the floaters on the bottom. Each of these show the net decrease. For jackups, they're down 43 since 2018, and floaters are down 69 since that same time period. On the bottom, the shaded areas show attrition, so that would be rigs either sent to um, the scrap yards for recycling, or they're perhaps converted outside the drilling industry, in some cases for wind or for production units, those kinds of reasons. And on the top, the solid bars represent deliveries, so that is new builds that were added into the market over that period. So while we have seen increased demand this year for jackups, that's been driven by the Middle East, and for floaters, that's been driven by the Golden Triangle, which is Brazil, West Africa, and the US Gulf. When you take this increasing demand and you add to that the shrinking new build fleet that's still uncommitted, little to no rig orders coming in, reactivation period for stacked rigs taking longer and longer, and what is left of the stacked supply, some cases they've had some cannibalization of parts, and in some cases they're just the less desirable units, meaning there are fewer that are actually readily available to be reactivated. This has created a condition for an ongoing tight market. So the tightness we've seen in 2022 is not a blip. We expect this will continue for the next few years. I'm focusing in a little bit on our undelivered jackup supply. We still have 27 units that have not yet been delivered. Only 2 of these have contracts, both of those for the Middle East. Shipyards own 18 of the undelivered rigs at present. What we saw at the beginning of the year was shipyards were more open to bareboat arrangements, but as the year has progressed and the market has tightened, we've seen a switch where shipyards now prefer to just find outright buyers. Now, what we will continue to see is that if the delivery deadline approaches and there's not a job in hand for that, or the yard has yet to find a buyer, those delivery dates are going to get pushed. So we do have some that we're watching closely that seem like they're good candidates to be pushed out a bit. Now, most of the undelivered jackups are desirable units. There's only one that's currently rated for just 300 feet of water. 20 of the undelivered rigs are rated for 400 feet of water or more. And so what this means is that these units will be delivered eventually. It's just a matter of when and to whom. And most of these will end up in the Middle East. And then as far as future orders, we do expect there will be future jackup orders, and those, of course, will be tied to the Middle East, where demand is heavily increasing. Switching to the floating rig supply, there are still 21 undelivered floating rigs, only one of which has a contract, and that's a high-spec drill ship with a 20K BOP stack that will be coming to the US Gulf early next year, in 2023. Similar to the jackup fleet, shipyards that own rigs now prefer outright sales as opposed to bareboat charter arrangements. But one thing that is different from the floater market is that some of these floating rigs that are still undelivered are less desirable. They were ordered several years ago as lower spec units, and now a lot of their technology or design is considered rather outdated. And so that makes these candidates less viable for purchase. A couple of examples are the Sete Brazil units that are still out there, and also the Opus Tiger series. We have heard that at least a couple of those have been visited by potential purchasers, but that is for use outside of drilling. What we've heard for a couple of them is that they've been visited as potential conversions to production units. And as Matthew mentioned a little bit earlier, one of the new builds, the West Aquila, was recently acquired by Aquila Ventures, and it will be managed by Transocean. That one is not yet contracted, but it is being offered in multiple locations, we understand. There are also 4 harsh environment semi-subs that are still under construction. Of course, those are primarily going to be targeted for the Norwegian market. We do expect that's still going to be rather weak until 2024. So we might not see much movement on those units anytime in the next few months or so. But there are a few alternative markets that are opening up as potential places to take on harsh environment units until Norway picks up, and that would be the South Atlantic and also the Bass Strait. Turning to our day rate forecast and starting with jackups, the Middle East is putting pressure on day rates in other regions. So in general, the jackup market has been more oversupplied than the floating rig market just because of sheer size. And so we haven't seen the amount of recovery or the degree of recovery in jackup day rates that we have in floating rig day rates. However, the increase in demand in the Middle East has drawn a lot of the premium units from other regions and moved them over to the Middle East. And what this has resulted in is smaller, tighter markets elsewhere, and that has in turn affected day rates, which we see climbing. Currently, premium independent cantilever units can be fixed anywhere between like 120 and 135 globally. Demand for premium and harsh environment units are going to continue to increase over the course of next year. In turn, that leaves some room for the vintage and standard units to take up a little bit of the slack as operators look for units that are more cost effective in their terms. But what will happen is that these will be pushed upward as well. So as operators turn to some of these units when they can, if their programs allow, that's going to sort of tighten up this market. So what we're seeing is sort of a trickle down effect in terms of day rates being pulled up based on pressure from Middle East growing market. And this is our day rate forecast for our floating rigs. This is a market that is very tight in certain regions and certain capabilities, especially the 7th generation drill ships on the upper end. We've had several rates already recorded above 400, and that's for the clean rate when you're stripping out mobilization and MPD and integrated services and things like that. And we do expect these rates will continue to trend upwards. If operators are seeking short-term campaigns or multiple short priced options, we are hearing that these are sometimes being returned with bids that start with a 5. However, we have not heard of any of these being fixed so far. This is just more an indicator of the direction that the market is going. Longer term programs and gap fillers, of course, are still being able to be priced in the upper 300,000s to low 400,000s. So it is the golden triangle that is driving demand for high spec units. There are entry barriers to the U.S. Gulf, and that's based on regulatory requirements for high shearing. It would be it would mean an additional cost and additional time off work in order to make these upgrades. And the jobs in the U.S. Gulf are still rather short term in nature. So what we're seeing is kind of a hesitation on the part of rig contractors to bring rigs into that particular market, which is keeping things pretty tight here. And then in Brazil, Petrobras is ramping up their activity and bringing additional capacity into Brazil to meet their needs. What we're seeing there is in some cases, we're seeing additional units that are currently stacked, that will be reactivated and brought in. We don't expect Brazil will, Petrobras in particular, will return to the height pre-downturn, but they are ramping up from where they were just a few years ago. And similar to the jackup market, what will happen within the floating rigs is that as drill ship day rates increase, operators will reassess their needs. And if they don't need the highest capability rig, if they can drop some of the bells and whistles from their program and use maybe a 6th generation semi-sub, then that will start happening. And that in turn will start pushing up day rates on that end of the market as well. In terms of open requirements, that is programs that are out there that have not yet been awarded to any one particular rig. We still have a lot of programs open for next year, even though the market is still pretty tight. A lot of these aren't necessarily going to be awarded in 2023. They're more likely to get pushed. What happens when day rates start going up is in particular pressure on some of the smaller operators that need financing or partner agreements. And so we start to see some of these programs slip. But this does show you that there is still a healthy amount of work out there if conditions are right. On the right, it's the same amount of work, but broken down by region. The North Sea stands out on this particular chart, and that's because the North Sea is the most transparent when it comes to the tendering process. A lot of the information is available via various regulatory regimes, and so that one makes that particular market stand out. It doesn't necessarily have that much more than all the others. Some of the strong ones are all relatively strong at this point in time. It's just appears a little bit stronger. And then a quick wrap up before we turn it over to Paul for the Q&A. We want to make sure to point out that the practical rig supply is tight. Not all the units that are idle are truly available or ready to be returned to market in a short term. Costs have increased across the board. Lead times are growing. Supply chain issues are going to continue to be a challenge globally. And that being said, the rig market is moving into a multi-year super cycle. So thank you for your attention, and we'll hand it back to Paul.
Thank you, Cinnamon Matthew. It's a lot of great information and some insight from the Esgian Rig team. We have had a couple of questions through the chat box. I wonder if we can just go through a couple of them. One was around day rates. You mentioned on the global time. I wonder if you've had any more breakdowns on sort of which regions will have the highest day rates going into 2023? Maybe that's one for you, Cinnamon.
Okay. Thank you, Paul. Yeah, so when it comes to drill ships, that's going to be U.S. Gulf. It's definitely leading the way with day rates just now. Brazil is following, and West Africa is lagging a little bit, but we've actually seen a really big jump in day rates over the course of this year from West Africa, so it's heading in that direction, but definitely will be led by the U.S. Gulf. And when it comes to jackups, well, the Middle East is going to be the main driver, but you also have the premium harsh environment units in the North Sea. And those, of course, the harsh environment rigs always collect a higher day rate.
Second group was I've put together was around sort of demand. You mentioned there about the West Africas. Can you expand a little bit more on the demand and break it down into some of the West African countries?
Yes, Paul. What we've seen is you've got really opening up a lot of current and upcoming demand in 2023 for activity offshore Angola, Namibia, and South Africa in particular. And for Angola and Namibia, that's bringing in high spec drill ships and semis, and in South Africa, even some harsh environment unit semi-submersibles from usually work in the North Sea have been brought over for work there as well. So all of those have drilling programs either currently or lined up for the next year or so.
Okay. ESG is getting a few questions coming through. You mentioned on the slides about how a lot of the upgrades and the rigs that presently have rig emission equipments all seem to be based in Europe. So do you expect regions outside of Europe to get more involved in the ESG emissions efforts going forward?
I think certainly going forward, there's growing interest in it really starts off in the North Sea, but there's a really growing interest in the Middle East, particularly as drilling programs there ramp up, is ways to mitigate that going forward. And I think, you are seeing increased, at least interest in it from other regions like the US.
Okay. I've just seen we've got time for probably just one more. It was quite an interesting time. The announcement yesterday from Saipem on the rig purchase. Do we expect more of the new build floaters to be purchased in 2023?
Okay, I can take that one, Paul. Yes, we do. We've heard anecdotally that several of them have already been visited, especially the higher capability, higher spec units. So I think it's just is trying to figure out financing and also work. A lot of these, the purchasers are wanting to get their returns and rather quickly in the first job if possible. And there just aren't as many term work still available as we've seen in the past, perhaps. And so that's putting a little bit of pressure on when they're going to come out, but we do think we'll see some more announcements in 2023.
So we've come to the end of the allotted time. So I'd like to thank everyone for attending today's presentation. For those questions, I know we had a few that we haven't had time to answer this morning. We'll definitely come back to those individuals and answer those questions directly over the coming days. Just to confirm again that this presentation has been recorded and we'll be posting it onto the Esgian YouTube web channel in the next couple of days, and we'll send a notice out to all the attendees to remind them that the system's there, and also requests for the copies of the slides will also be sent out in the coming days. So again, thank you very much for everybody's time to attend. We really appreciate you taking the effort, and that concludes today's presentation. Thanks, everybody.